We're going to do it the way that we always do it, and it's always done when countries essentially go broke. What they do is they, through a combination of devaluing the currency, printing of money,
Right.
There's an imbalance. They print money, devalue the currency, and create an artificially low interest rate so that the person who's holding the bonds is receiving an artificially low interest rate. That's the way Japan has done it with their local, and that's the way we will do it.
So in other words, my grandchildren and great-grandchildren not yet born are going to be paying off this debt in devalued dollars, more or less.
It's going to happen faster than that.
Faster than that. Oh, okay.
I think they'll probably be beyond that.
All right, do you think it's...
So the way it works is you have that dynamic. So watch the value of the dollar, but also not just in relationship to other currencies, but look at it in relationship to gold, which, by the way, is the second largest reserve currency. First is dollars, then gold is the second largest reserve currency, then euros, and then yen. Okay, it's that currency. But anyway, look at it in there. You'll see a depreciation in the value of the dollar, I believe. Right. And then you're going to see artificially low interest rates as a means of doing that. And my concern is that if you have this dynamic happening at a time when there's a recession, which is the most likely scenario, then you'll see budget deficits rise, and you're going to see a population at each other's throats. So you're certainly not going to see in a recession that they're going to say, I'm going to increase my taxes or cut the benefits. So you're going to see a very difficult social, I think, political and economic set of circumstances. I think that first of all, I don't want to throw out tips, but I'll give you my thoughts from the point of view of what are safer investments.
Okay.
Okay.
Well, you're a pretty famous investor, so I'm probably going to listen to you. Right?
and keep in mind that I've been wrong. So first, look at the value of your portfolio in inflation-adjusted terms, not in nominal terms. Okay? And the safest investment that you can get right now is an inflation index bond, because what you'll get is it'll be indexed, and you'll get a bit over 2% real return above inflation, and whatever happens. So you start with what is a safe investment. The next thing I think you have to do is diversify your portfolio. We talked about the powers of diversification. So I don't want to get anybody into one bet because I'm going to be wrong, but do consider that gold is a form of money, and gold is that central banks are acquiring gold now as a diversifier, and so it also is negatively correlated with most of the things that you have. In a time of great stress, what you'll find is that the gold will do well, and when the assets don't. The world used to have gold as money. That was the way. And so the world would look at things differently. They would look at the prices of things in gold terms. Now, because we have fiat money and we've become used to it, we look at the prices of things in money terms, and we look at gold that way. I think if you started to say it's money, it's a source of money, and you have that, that's part of the diversify. So it would diversify your portfolio. It's a prudent thing to have somewhere between 10 or 15% of your portfolio in gold. So if you put in some inflation index bonds and you put in gold, that will diversify your portfolio relative to the things that you have in it. Those would be the general thoughts I would convey. That would not be getting you into a riskier position. That would be getting you into a safer position. So it's no big bet. It's a reducing of your bet by putting you into a position in terms of real purchasing power for your portfolio. As they say, since 1750, 80% of the world's monies have disappeared, and all of those that existed have been greatly devalued. That's one of the reasons that gold is a storehold of wealth and has been for a long time. And there's a saying that gold is the only asset that you can have that's not somebody else's liability. And what they mean by that is that you don't have to receive money from somebody else. In the world that we're now in, and we're seeing it internationally, there's a worry about sanctions. There's a worry about taking gold. Those holders, central banks around the world, are concerned about the possibility that, let's say, what happened to Russia could happen to them, and so on. So there's a diversification of that. And it creates a dynamic in and of itself, because what happens is if they are switching, and they are switching, to gold away from bonds and so on, then that has the effect of not only making our supply-demand balance that we're talking about the new deficit, it means that you can have the selling of gold, which makes that supply-demand balance worse. You know, probably, presumably that's right, but not if you watch these these cycles, that because you have the devaluation, then people don't have confidence in the fiat system over a period of time. And through history, they've, at that point, the way that works is you print all this money, then you pay the debt with the cheap money, but nobody wants to hold it, so then they go back and link it again. It is conceivable that you can see a relinking of gold to money, but that's way in the future. I think the picture would be some version, their concern, would be some version very similar to the 70s you just talked about. I remember I was clerking on the floor of the New York Stock Exchange on August 15th, 1971, and that is when Richard Nixon got on the television, and he said in his polite way, this was a wonderful move, but the money that you thought you had, the gold was money, and what at the time people thought were the money that we're used to, they would say are like checks in the checkbook. They said, you're not going to get your money, you can keep the checks. At that point, then we began the 70s. And the 70s was a period in which there was both stagflation. The thing that we have to worry about is a stagflationary environment because all the currencies went down. So when you were looking at diversification, the problems that we're talking about are not just American problems. We have a significant problem. But they're European problems. They're Japanese problems. There's Chinese problems. We've lived on promises to be able to take that dead asset and convert it into money. And now there's not enough money to go around. So I would say that when you ask the question, would I devalue in relationship to other currencies? Probably. But the other currencies won't want much of an appreciation. And so that's why I'm saying that something like gold will be the better performing currency.
Some people worry about this and can tell us whether this is realistic or not. In 1985, there was something called the Plaza Accords, where the United States government agreed with other governments that we were going to devalue the dollar illegally, officially, and it was done in secret. Nobody knew it was coming. Is that a possibility that the government of the United States could again agree with other governments we're going to devalue the dollar further, or you think that's unlikely these days?
No, I think it's a possibility, yes. And it's so interesting. In history, when you look at what happens when governments are in certain positions, all through history, they do the same things, okay? And that means that a move like that, or even there could be foreign exchange controls, there can be different ways that happens.
You didn't mention, throughout history, there have been two things that people have always wanted as a source of wealth. One was gold, and maybe silver, you could argue too, but gold, and then real estate. And what do you think about, if you're nervous about paper currency and the valuation of it, why not just buy real estate and hold on to it? Is that not a good idea?
It's not a good idea.
No.
It's not a good idea because, first of all, real estate is more interest rate sensitive than it is even inflation sensitive. So if you were to say, if this environment happens, does it go? It goes down in real terms. It's also an asset that is a fixed asset that is the easiest asset to tax. In other words, in any place, you're in a particular state, putting in real estate taxes means that they could always get the money. And so it's not an effective diversifier that way. And also being able to move money from one place to another, the real estate is nailed down. There is the real interest rate and one man's debts or another man's assets. And so if I lower the interest rate, I will reduce my desire to hold that bond. And in my opinion, if you do that too much, you will lose the demand for those bonds. Unlike if you do create something closer to the 4% cut in the expenditures, 4% increase in the tax revenue, improve the balance, then you'll have a benefit. If you try to force interest rates down, you are hurting those who are holding the bonds, and you will lose the demand for the bonds, and you can create that spiral. An inflation index bond.
Which is index fund.
TIPS, Treasury Inflation Protected Securities, because it will guarantee you a real return. And I don't think that you should be speculating in the markets, because there's a zero-sum game and you'll probably be the loser.
Now, my perception is that people in Washington always say, well, if the situation was that bad, the bond market would collapse. And then the bond market people say, well, if the situation that bad, Congress wouldn't do this. And they both kind of blame each other for not doing anything. Why hasn't the bond market collapsed over the fact that we have all this debt over all these years?
You know, like the saying, I've experienced this many times. I did this analysis in 2007 and 8. I went to Congress and everybody said, they asked me the same question, but we had the problem. Same thing happened in Europe. So there's a supply demand. There's a saying, you know, that everything goes slowly until it happens all at once. When the problem happens, you know, these things happen like that. Tariffs are not bad. Throughout history, tariffs were the main source of government revenue and so on. And any form of taxes has its cost. So capital gains taxes are bad and so on. Different things have their costs. I think the question is how well executed, how big are they, how disruptive are they in terms of the process. They can bring there's something to be said for them in that they bring in a significant amount of revenue. That means that there's less that's needed elsewhere. And we're now in a different world. We're in a world where the world is almost at war. There's self-sufficiency. We have to build self-sufficiency. We cannot continue to borrow or depend on imports for that. And so there's a manufacturing. How do you create manufacturing in the United States and so on? There's some merit to all of those arguments. The question is whether that is done really well and so on. For the whole world, tariffs, of course, are not the ideal. You would like to have, if you're dealing what's best for the whole world, you would like to have the least inefficiency. You'd say wherever they produce it the best, and we have it go around. But we're in a world now that we have to be realistic in terms of we cannot be dependent on importing a lot of things, and nor can the world be dependent on the value of the bonds and the debt that we're acquiring in order to pay for those things.
Gold and silver have once again captured the spotlight as America teeters on the edge of unprecedented financial and political instability. With Donald Trump's recent surge in polling numbers despite multiple legal challenges, and the U.S. economy walking a tightrope of inflation, rate uncertainty, and record-breaking debt levels, it has become abundantly clear that the fiat system, rooted in endless money printing and blind trust, is broken. Gold and silver are not just alternative investments anymore. They are lifeboats in a storm of economic and institutional collapse. Every fiat currency in history has eventually failed. The US dollar, once backed by gold, now floats on the whims of policymakers and central bankers. The Federal Reserve claims to fight inflation, yet it created the very problem with years of near-zero interest rates and trillions in stimulus. And now, with CPI inflation numbers still sticky and consumer sentiment in freefall, they've cornered themselves into a lose-lose situation. raise rates and tank the economy, or ease and ignite another inflation wave. Either way, fiat suffers, but physical gold and silver, finite, real, and time-tested, thrive. In the last few weeks, silver has quietly outperformed many other assets, pushing past key resistance levels while being largely ignored by the mainstream media. Gold, too, is testing all-time highs amid global central bank accumulation. Why are nations like China, Russia, and even Poland buying tons of gold while telling their citizens to hold cash? Because they know what's coming. They know the dollar is losing its dominance and that the next financial system won't be built on paper IOUs. It will be anchored to something real. Trump's return to the headlines isn't just about politics. It's about economic sentiment. His recent statements slamming the Federal Reserve and calling for a return to sound money are echoing louder than ever. Trump understands that Americans are losing faith in the institutions that manage their money. Confidence in the Fed is near all-time lows. The Treasury is issuing debt at a breakneck pace. Social Security is on track to go bankrupt. Meanwhile, the stock market continues to float on speculation, artificially supported by Fed jawboning and tech hype. But beneath the surface, cracks are forming, young investors are waking up. They're beginning to see the trap. Save in dollars, and you're guaranteed to lose purchasing power. Trust in stocks and crypto, and you're subject to manipulation and regulatory whims. The only assets with a 5,000-year track record of preserving wealth through every war, recession, and regime change are gold and silver. And right now, silver is arguably the most undervalued strategic asset on Earth. Not only is it a monetary metal, but it's also essential in solar panels, electric vehicles, and industrial applications. The supply is shrinking while demand is surging. This is not a speculative narrative. It's a supply chain reality. Meanwhile, America is sleepwalking into another debt crisis. With over $34 trillion in national debt and interest payments now rivaling military spending, the writing is on the wall. The government has no plan to pay it off. The only tool they have left is inflation. Silent theft through currency debasement. If you're holding dollars, you're the victim. Every printed dollar makes your savings weaker. Every stimulus check, every bailout, every new government program funded by the printing press, it's a transfer of your wealth to the state. Look at the banks. Regional banking stress has returned, and big names are warning of a new wave of collapses. If even one major institution falls, a domino effect could ensue. And with FDIC reserves under pressure and trust in banks declining, people are beginning to ask serious questions. What happens to my savings if the system locks up? If you can't hold it, you don't own it, and that's why physical metals are making a comeback. Gold and silver require no counterparty. They cannot be hacked, frozen, or inflated away. They don't rely on government promises or Wall Street gymnastics. In times of war, regime change, or collapse, like the world is inching toward now, they are the final fallback. Just this week, Trump warned that America is closer than ever to losing the dollar as the world reserve currency. That's not alarmism, it's fact. The BRICS nations are actively developing a gold-backed trading currency, and the world is watching. The petrodollar era is ending, and with it, the dollar's dominance. Gold and silver will outlive fiat. They have outlived every empire that thought it could print its way to prosperity, and they will outlive this one too. While Wall Street distracts you with AI stocks and debt-fueled bubbles, the smart money is quietly accumulating hard assets. If the monetary system resets, and history shows it always does, those holding metals will have purchasing power while everyone else scrambles for crumbs.